Welcome to the Opening Bell Report.
Okay, let's play a little game. Guess the stock.
Mm-hmm.
I'm looking at a company right now, and it's putting up just monster numbers.
Okay, I'm listening.
We are talking 49% year-over-year revenue growth, almost 50% in this economy. That's, hyper growth.
It is. Normally when you see a number like that, Wall Street pays a huge premium for it. I mean, 50% growth should get you a valuation that makes your nose bleed.
Exactly. The stock chart should look like a rocket ship. But here's the twist. This stock is not taking off. It's trading like a distressed asset. It's bumping along near its 52-week lows, around $15, maybe $16.
It is one of the most fascinating and just violent disconnects in the market right now. The numbers say one thing. The stock price says the complete opposite.
So today on the Deep Dive, we are looking at that company, HIMS and HERS Health, ticker HIMS. And we're digging into an analysis report that previews their upcoming earnings call, which is estimated for February 23rd, 2026.
And this report makes a really strong point. It argues this call isn't just about the past. It's not a victory lap.
No.
The whole thing, the central thesis, is that this call is entirely about future legal viability.
Right. It's a showdown. You've got the math on one side, which is just screaming buy, and then you have the lawyers, from Big Pharma screaming stop.
And the report frames this as a really binary outcome. That 39% growth, that's the stock's only lifeline. If guidance even hints that slowing down, the whole value trap argument wins.
But if they can prove it's sustainable,
then it's a completely different story, a total repricing event.
So let's unpack that. This core conflict the report identifies. Let's start with the good news, the bull case. Why do the numbers scream buy? Because a valuation feels like a glitch in the matrix.
It really does look like an anomaly. Let's talk about the PE ratio, the price to earnings ratio.
The classic metric for how expensive a stock is.
Exactly. And typically, a company growing revenue at nearly 50%, investors will pay up for that.
Yeah.
You'd expect a PE of, 50x? Maybe even 80x? You're paying a premium for that speed.
You're buying the future growth today.
But HIMS, they're currently trading at a PE of around 29x.
29. I mean, that's incredibly low. That sounds like a bank or a utility company, not a high-flying health tech name.
It's a massive disconnect. The report says it explicitly. On paper, based on the math, the stock should be double where it is today. An algorithm just scanning for high growth, low price would be going haywire over this.
But it's more than just the PE, right? The report brings up something they call a cash flow fortress. What does that actually mean? Because we see a lot of companies grow fast while just burning money.
And that is such a crucial point. So many of their peers are cash burners. They're constantly raising money, diluting shareholders, taking on debt just to fund that growth.
The old growth at all costs model.
Right. Selling $1 for 90 cents. HIMS is the opposite. They are printing cash. The report highlights $149 million in operating cash flow in Q3 alone. And get this, they have over $1 billion in cash on the balance sheet.
$1 billion in the bank.
Yes, that's a lot of dry powder.
Right.
Totally changes the risk profile. This is not a company that's going bankrupt anytime soon.
And that cash,
Okay.
it gives them options, I assume.
It does two things. First, it's a safety net against the legal stuff we'll get to.
Yeah.
But second, it's ammo. They can buy back their own stock if they think it's cheap, which supports the price. Or
They can go shopping.
they can go acquire smaller competitors, diversify the business. That optionality is huge. And it leads to the third part of the bull case, the core strength.
Okay.
There's this huge misconception that HIMS is just a weight loss company now, just a vending machine for genetic Ozempic.
Well, let's be fair. That has been driving the headlines, the compounded semaglutide.
It's driven the headlines, absolutely.
Right.
But the report argues, and I think it's a strong argument, that if you strip out the weight loss drugs completely, the core business is remarkably strong.
What's the core business in this case?
Hair loss treatments, skincare, mental health medications. That part of the business historically was growing at over 40% all on its own.
So the idea is that the market is panicking, pricing the stock as if 100% of their revenue will vanish overnight.
Precisely.
But even in a worst-case legal scenario, there's still a big profitable business under the hood.
Exactly. The report calls the market's reaction irrational because it ignores that legacy strength. The hair loss business isn't facing a lawsuit. The skincare business is fine. Those are cash cows.
Okay, so that's the bull case. It's cheap, it's got a mountain of cash, and the core business is solid. If I stopped reading there, I'd be all in.
But you can't stop there.
No. We have to talk about the bear case, the wall of worry. Why does the market hate this stock so much right now?
Because the market hates uncertainty more than it hates bad news. With bad news, you could price it in. With uncertainty, you're flying blind.
And the source of that blindness is what the report calls the Novo overhang.
This is the lawsuit from Novo Nordisk, the makers of Ozempic and Wegovy.
Right.
They are being very aggressive about protecting their patents, and they're going after companies selling compounded semaglutide. Now, for anyone listening, compounding is basically when a pharmacy mixes up a custom version of a drug.
And there's a specific reason they're allowed to do this legally?
Yes.
Yeah.
Under FDA rules, if a drug is on the official shortage list, which Ozempic and Wegovy were, pharmacies are allowed to compound it. That is the legal allowance HIMS has been using.
But the shortage is ending.
That is the problem. Novo is ramping up production. And as that shortage resolves, the legal ground HIMS is standing on gets very, very shaky.
So this isn't just about a potential fine. The report calls it an existential threat. That's a strong word.
I think it fits. Because if the FDA officially declares the shortage over, or if a court rules against HIMS, a huge chunk of that 49% growth, it could just evaporate overnight. Yeah. We're talking about a revenue cliff, not a small dip.
So the fear is that this amazing growth story was built on basically a temporary loophole.
That's the bear case in a nutshell. And it's compounded, no pun intended, by fears about their profit margins.
Okay, tell me about that.
The report notes that gross margins dropped. They went from 79% down to 74% in Q3.
A 5-point drop. Why is that so significant?
Well, it tells you that while they're selling more, they're making less profit on each thing they sell. It suggests their costs are going up or they're competing more on price.
Or the product mix is changing.
Exactly. Hair loss pills are cheap to make and ship, very high margin. These weight loss injections, they need cold chain shipping, refrigeration. They're much more expensive to source and handle. So as that becomes a bigger piece of the pie, the overall profitability goes down.
And then there's the churn risk, customer loyalty.
Right. Think about it. If you're a guy buying hair loss pills from HIMS, you're probably a customer for years. It's sticky.
But the weight loss customer
might be much more transactional.
Yeah.
If you only signed up to get cheap access to a weight loss drug and suddenly HIMS can't sell it anymore, are you going to stick around and buy their face cream?
Probably not. You're going to find who has the drug.
You churn immediately. So the quality of that new revenue might be much lower. It's rented revenue, not owned revenue.
Okay, the stage is set. Incredible numbers versus an existential threat. So for this earnings call on the 23rd, the report lays out a watch list. 3 metrics that actually matter.
Yes. And the first one is interesting. They say to ignore the year-over-year headline number.
Ignore the 49%.
For a moment, yes. The headlines will all say 49% growth, but the real test is sequential revenue growth, quarter over quarter.
So how they did compare to last quarter, not last year, why is that more important right now?
Because year over year is a rearview mirror. Quarter over quarter tells you what's happening right now. In Q3, they did about $599 million in revenue. The big question is, did they beat that number in Q4?
And if they didn't? If they're flat or down?
If they're flat or down sequentially, it's a huge red flag. It proves the growth story has stalled, that the rocket has run out of fuel. It would be the danger zone, as the report calls it.
Okay, so metric 1, beat last quarter. What's metric number 2?
The core versus GLP-1 split. Analysts are going to be digging through the report for a breakdown of where the money came from. How much was hair and skin versus how much was weight loss?
We need to see if the foundation of the house is solid.
We do. The hope, the bull case, is that the core business is actually accelerating. If that's growing fast, the stock is much safer. But the fear is that the entire 49% growth was driven solely by the risky weight loss drugs.
Which would mean the core business is actually slowing down and the weight loss revenue is just masking the problem.
You got it. If that's the case, you're putting all your eggs in the one basket that has a big hole in the bottom. The risk is extreme.
And that leads right into the third metric, which is probably what everyone will be listening for on the actual call, legal guidance and strategy.
This is the elephant in the room. Management can't just get on the call, read the numbers, and hang up. They have to address the Novo Nordisk situation head on.
What do they need to say? Is, we're confident in our position good enough?
Absolutely not. The report warns that vague answers like that will get punished by the market. Investors need specifics.
Like what?
Like, we are diversifying our supply chain.
Yeah.
Or we are launching a branded partnership to sell the name brand drugs. They need to show the market they have a plan B and a plan C. If they just say, trust us, the stock is going to get hit hard.
So let's play this out. The report gives 3 possible scenarios for what happens after the call. Let's do scenario A, the best case, the all clear.
This is the rocket ship scenario. You need 3 things: a sequential revenue beat, strong guidance for the next quarter, and a very clear, defensible legal plan. If they deliver that trifecta, the report says the stock could jump 20 to 30%, back up to $20 or more, fast.
That's where the short squeeze could happen.
Precisely. A lot of people are betting against this stock. If the news is great, they all have to rush to buy shares to close their positions, and that buying pressure just pours fuel on the fire.
Okay, what about scenario B, the mixed bag?
This one is confusing. Maybe they beat on revenue, the numbers look good, but the guidance is weak. Management sounds cautious, or they don't give that clear plan B on the legal front.
So what happens to the stock?
It probably stays choppy, flat, stuck in that $15 to $17 range.
Yeah.
The bulls are relieved it didn't crash, but the bears aren't scared away. The uncertainty just continues.
And then there's scenario C, the disaster.
This is the nightmare for anyone holding the stock. Capitulation, the conditions would be a miss on revenue, margins getting even worse, and this is the key. No meaningful update on the legal strategy. Just silence.
Silence would be deadly here.
It would be. If that happens, the report predicts a drop of 15, maybe 20%. You can see the stock fall to $12 or $13. That's the value trap snapping shut.
It really feels like they are walking a tightrope. So what's the final verdict from this report? It's summed up as high risk, high reward speculation.
That's really the only honest way to frame it. It is speculation at this point. The growth is real, but the market is pricing in a massive risk that it could disappear.
The report also mentions the technical setup. The RSI is under 30, meaning it's oversold.
Yeah, in simple terms, it means the selling has been so intense it's like a rubber band that's been stretched too far. Even a little bit of good news could make it snap back hard. That's why that all-clear scenario could be so explosive. The spring is loaded.
But for a long-term investor, not a trader, the report gives some kind of counterintuitive advice.
It does. It suggests it's actually better to buy the stock at $18 with clarity than at $15 with this existential risk.
Wait, so buy it higher. That goes against everything you learn. Buy low, sell high.
Usually, yes. But in this very specific case, you are paying a $3 premium for certainty. If you buy at $15 right now, before the call, you are gambling. You are flipping a coin on a legal battle.
Right.
If you wait and the stock jumps to 18 because they laid out a brilliant legal strategy, sure, you missed the absolute bottom, but you are buying a company that you now know has a future.
You're paying a premium for a good night's sleep, confirming the floors are real before you step on it.
Exactly. Don't be a hero trying to catch a falling knife. Wait to see if they've even got a floor.
It's just a fascinating case study. HIMS is a battleground. Undeniable math versus undeniable legal risk.
And this earnings call is the moment those two forces collide.
I love the final thought the report leaves us with. It's almost philosophical. It says, growth can save the stock, but only if HIMS proves that the growth belongs to them and not just a temporary loophole in the pharmaceutical industry.
That's the entire question, isn't it? Are they a real brand that people trust, or are they just a loophole? We're about to find out.
We certainly are. February 23rd. Keep an eye on those three metrics: sequential growth, the core versus GLP-1 split, and the legal plan.
And maybe keep some popcorn handy. It's going to be interesting.
Absolutely. Thanks for joining us on the deep dive. We'll see you next time.
Don't forget to like, share, and subscribe for more.